Thank you all for your patience. Welcome to the UVA's Open Enrollment Virtual Town Hall. I'm Beth Danahy from your Faculty Employee Assistance Program, and here to share a little bit about FEEP. So what is FEEP? We are a program that's been in existence for close to 30 years. We are a confidential and free resource providing support for employees in any capacity associated with the university, as well as your adult family members for any situation that you may encounter that creates any kind of distress for which you might like some support. We have a diverse team of professional consultants, some of whom are licensed mental health professionals, some of whom are coaches, and our only role is to be of support to you all. So we provide assessment. So whatever is happening in your life, we provide a thorough assessment to help guide you to the best resources. And when it's appropriate to stay within FEEP, we provide brief counseling and support. We provide recommendations, help problem identification and support, and referral to resources. So if your circumstances, your symptoms need more specialized care or are outside the scope of an EAP program, then we'll provide recommendations to referral resources in the community or within the institution and help guide you to those resources. Really want to emphasize confidentiality here. This deserves its own slide in our view because it's so important to us for our community to know that our resources are absolutely confidential. There's still, we find from time to time, a number of people that are not aware that our services are confidential because I think primarily we do work for the university. That doesn't mean that we're not confidential. So anything that is shared with FEEP cannot be shared outside of FEEP without written permission from the person or persons that we've worked with. So you would know because you would be asking us to provide that kind of communication to anyone. So even a family member that might contact FEEP and say, hey, I've suggested that my spouse or family member has come to FEEP. Could you let me know if they have an appointment? We cannot confirm or deny that. If anyone from HR, a manager, anyone within UVA would like information about contact with FEEP, we will not provide that information without a written release from the individual. So we follow all of our professional and governmental guidelines about HIPAA compliance and protected health information. Even our services, when we provide virtual services, virtual resources, we provide those over HIPAA compliant Zoom, a Zoom platform. Wanted to just share a little bit here about FEEP for You, which is an online platform on our website that is specifically for our community, for our clients, and for anyone within UVA. This is available 24 hours a day. You can log in through NetBadge and access a whole wealth of resources from our newsletters, archived tip of the month. We have short videos that can provide support in the moment, the recordings of our webinars that we collaborate with Who's Well on those, and those are saved on our website there. And so all kinds of resources that you can access at any moment when you might like some soothing sounds or some guidance around grounding or anything that could be helpful to you, please check out our FEEP for You. We have a couple of specialized roles within FEEP that we wanted to make you aware of. We have a team member who's focused really on prevention, mental health awareness, and provides a lot of orientation, information about mental health awareness, around FEEP resources. So if you would like to engage us for a team or have us come in and partner with you to help in that regard, you can reach our team on that. And then also we have fairly new a crisis and care coordinator. So his role is to really assist managers and employees when you're in any kind of a crisis in the team or a mental health crisis of an employee. You can reach out to us. The last thing I want to say that's important, that's a little bit new, is that our entire team is trained in trauma-informed care and are all equipped to provide safety and stabilization around traumatic circumstances. So we are informed around trauma and how trauma impacts our body, mind, spirit, and performance. And so we're here for you. If you would like an appointment, you can reach us on the web. You can send a virtual request or you can give us a call. Certainly if you need support very quickly, give us a call so that you can reach us quickly. But typically we're striving to provide an appointment within 3 business days, and that can be a reasonable expectation. So thank you so much for your attention, and we'll save all questions until the end, and Claire will guide us in answering those. And next up, we've got Vic Tringali from Who's Well.
Good afternoon, everyone. Hope you're all having a good and productive day. My name is Vic Tringali, and I lead the design and delivery of Who's Well, which is University of Virginia's award-winning employee well-being program. Who's Well encompasses 4 domains of well-being: physical, emotional, social, and financial. And so we have a wide variety of resources and supports that support each of those domains of well-being. And so accordingly, our mission is to foster a culture of health and well-being among university faculty, staff, and team members. So each year, Who's Well offers a variety of health-related activities that are reward eligible, meaning there's a monetary reward that you can achieve for completing these activities. And employees and spouses on the UVA Health Plan or the UPG Anthem Plan have the opportunity to earn up to $500 in rewards for completing these health-related activities. The rewards are deposited at the conclusion of each quarter into the subscriber's paycheck. And many of these activities are relatively simple one-time actions. So for example, you can complete a personal health assessment, which is essentially a survey, a 15-minute survey that gives you a baseline of how you're doing with your well-being and gives you some suggestions or at least some guidance as to some things that you might want to work on. You can also document your wellness exam, your annual wellness exam, or a flu exam. Those are also reward eligible. And we have a wide variety of other activities that you can participate in, such as tracking your healthy habits, tracking physical activity. You can attend a variety of educational webinars, all of which are accessible and are earned rewards. There's also a number of other activities that span across the 4 domains of well-being that you can also find within our wellness platform. Many of these are delivered digitally or in a web-based platform, so they're very easy to access, and you can also have things that you can find that will meet your needs and interests. An important date that I did not point out, but I will point it out now, is November the 30th, 2023 is the last day to report and record any activities within the Who's Well portal. Now, what that means is you still have some time, if you haven't done so already, to register in the Who's Well portal. We'll give you a little nudge to do that if you haven't already, because you get $10 just by signing up a new account. Registering is very easy. We even provide you step-by-step instructions on our website, who'swell.com. Just look under the FAQs tab and we'll give you clear instructions of how to do that. And then finally, coming up in just a few months, the Who's Well platform will refresh, as we call it, in January of 2024, where employees and spouses, again, on the UVA Health Plan and the UPG Anthem Plan, can earn another $500 in rewards. And if you'd like to learn more about Who's Well, please visit our website, who'swell.com. Thank you.
Hi, everybody. I'm Erica Wheat, and I'm a part of the benefits team. And I'm here today to talk a little bit about open enrollment itself and the health and dental and vision options you have to select from during open enrollment. So welcome to day 3. So you've got until October 13th to make your open enrollment decisions about the plans that you want to be in for 2024. And open enrollment is the only time of year that you can actually change the plan itself. So if you are on, let's say, the value plan and you want to make a change to the basic plan or the reverse, open enrollment is the one time of year that you can make that change. So before we get started with kind of going through what your health insurance options are, I did want to say that there are no changes to the plan designs for the choice, value, and basic options on the UVA health plan from this year to next year. The only thing that is changing are the premiums, and we'll touch on that in a second. Before I get started with kind of looking at the plans themselves, I just wanted to briefly review some common terms that you'll hear about that with regard to with regard to your health and dental insurance. And the first thing is a deductible. So a deductible is the amount of money that you have to pay before your health insurance or dental insurance starts to pay anything of a covered claim. A copay is a fixed amount that you pay at the point of care. So you go to the doctor and you pay a copay for that visit. Coinsurance is the percentage of a bill that you have to pay once your deductible has been met. And then the out of pocket is the most amount of money you would have to spend in a given year on health insurance if you happen to have a lot of claims and your coinsurance is going up. You only are responsible for but so much before the plan starts to pay at 100%. And premium is, of course, the amount that you have to pay to have the coverage. So it's the deduction that comes out of your paycheck. So on the UVA health plan, you've got the three different options: choice, value, and dental. And many of all three plans share certain things in common. So first of all, each plan covers the same services. So it doesn't matter whether you're on choice, value, or basic, the same services are covered on all three plans. All three plans also share the same out-of-pocket maximum. So the out-of-pocket maximum is the worst case scenario, how much you have to pay in a given year. It's the same on all three plans, and it's $5,500 for individual coverage. And if you have dependents on your plan, it's $11,000. And then preventive care is covered on all three plans at 100%. And preventive care are things like annual physicals, well child visits for young children, routine maternity visits, and preventive diagnostic tests like a screening mammogram or a colonoscopy. Everything else would go towards the deductible and the coinsurance on the plan that you have. So the basic plan is our high deductible health plan. On basic, if it's just you on the plan, you have a $2,000 deductible. If you have family members on the plan, you have a combined $4,000 deductible. Once that deductible is met, the plan begins to pay part of your bill, and that's the coinsurance. So 80% would be paid by the health plan, and 20% would be paid by you until you got to that out-of-pocket maximum. On the basic plan, you are eligible for something called a health savings account. And that health savings account is money that you receive some funds from UVA, and then you can contribute out of your paycheck, and you can use those funds to pay for things that aren't covered by your health, dental, or vision. If you are on the basic plan and it's just you on the plan, you receive $1,000 in January to help with that $2,000 deductible, and then you can contribute on your own. If it's you and dependents on the plan, you receive $1,500 from UVA in your health savings account, and then you can contribute on your own. The value plan is a more traditional plan under IRS rules. It doesn't qualify as a high deductible plan. On value, you have an $800 deductible if you're an individual on the plan, or if you have dependents, there is an individual deductible of $800. But if the family somehow gets to $1,600, the deductible is considered met for everybody else on the plan. On the value plan, a cost for prescriptions go towards your deductible, just like they would on basic. But there are certain prescriptions that skip the deductible. So if it's a generic prescription, you're just going to pay a flat dollar copay. And if it's a prescription that's on the chronic and preventive medication list, if your medication is on that list, it skips the deductible as well and goes right to the coinsurance. And I should have emphasized too, on the basic plan, it's a similar thing. There is something called the preventive list, and if your medication is on that list, you're not subject to that $2,000 or $4,000 deductible. It just goes right to the coinsurance. The value plan is our only plan that has copayments, and those are those flat dollar copays. So if you're on value and you're going to see a UVA doctor, primary care, you're going to pay $25. If it's Aetna network but not UVA, that copay is $40. And then for a specialist, it's $50 if it's a UVA doc, $80 if it's Aetna network. And then anything else outside of that doctor's office visit, so for example, if they do any testing or x-rays, things of that nature, that would go towards your deductible. And once that was met, it would go to the coinsurance, which is 80% paid by the plan and 20% paid by you. Last but not least, we have our choice plan. It's the most expensive of the plans when it comes to premium. It's got the lowest deductible, which is $500 for an individual or $1,000 for an employee with dependents on the plan. Like the value plan, generic prescriptions are a flat dollar copay, and then prescriptions that are on the chronic and preventive list would skip the copay and go right to the coinsurance. If your medication is not on that list, then you would have to meet your deductible first, and the coinsurance would kick in. So real quickly, as I had mentioned, the only thing that's changing for next year is that the premiums have gone up a little bit for 2024. Most of the costs are being borne on the employer side, so the employer contribution has gone up a lot, but the premiums paid by the employee are also increasing for next year. And what you'll see on the slide is that the amount that is not in bold is the premium for next year. So for example, if you're an individual and you're on the basic plan, you're going to pay $30 a month for coverage. It's a $5 increase over next year, over last year, or this current year. And for example, if you're on the value plan and you've got individual coverage, it's going to be $96.50 for next year, and that's a $4.50 increase. But across all plans and all tiers, the employee premium has gone up a little bit, but the employer contribution is really taking on most of the cost increase. So now let's talk about dental. So you can also choose to, change dental plans during open enrollment. We have two different options, basic and enhanced. They share many some of the same features. So, for example, everybody on dental is eligible for what's called the United Concordia Elite Plus network. That change actually was made in July, and it's an expanded network of dentists. And the plan has a $50 deductible, both the basic and the enhanced, for services that are not preventative. So if you're getting a cavity fixed or you've got a cap or a crown, there's a $50 deductible that you pay before the plan pays. And then for preventive care, so for your 2 cleanings a year and your annual x-rays, as long as you're going to a dentist that participates with United Concordia, the plan's going to pay 100%. Now let's look at how they're different. So the biggest difference between the basic and the enhanced, outside of the premium that you pay, which you'll see in a second, is the amount of coverage you can receive in a given year. So if you're on the basic plan, anybody that you're covering on the basic plan is eligible for up to $1,000 a year in claims. If you're on the enhanced plan, the plan will pay up to $2,000 a year in claims. The enhanced plan is also our only plan that covers orthodontia. And for major restorative work like caps and crowns, the percentage that the plan will pay is slightly higher, the percentage of the bill. So on the enhanced plan, it will pay 60% and you pay 40%. On the basic plan, you pay 50% and the plan pays 50%. But the big difference is really in that annual maximum benefit. So premiums are not changing for dental or vision next year. They're remaining exactly as they are, and I think this is our 6th or 7th year of having the same plan premium. So you'll see there is a pretty significant difference between premium for basic and premium for enhanced, and that's because people on enhanced are getting more work done, and so that's in turn increasing the premium. So if you're somebody that just goes to the dentist a couple times a year, and you maybe have the odd cavity, you're probably fine on the basic plan. But if you know you need a lot of dental work, or you've got somebody who's going to be needing braces, you might want to consider the enhanced dental plan for 2024. We touched on a little bit of the premiums for vision, so they're not changing at all, and they were on that past slide. But there are 2 different vision programs. The first is just the Aetna Vision discount, and that's open to everybody that's on the UVA health plan, and it's just a modest discount off of eye exam, glasses, contact lenses. But if you're somebody who has who wears glasses or contact lenses, or you have family members that do, you can look at doing Davis Vision. So Davis Vision is actual insurance coverage. It's not going to pay all of your bill, but it will pay a lot more than it would if you didn't have Davis Vision. So it covers an eye exam, and then it will pay a bigger percentage of getting either glasses or contact lenses. And there are also discounts on things like transition lenses and hearing benefits. So moving on to our life insurance. So for individuals who are in VRS, your life insurance benefit is through the state. So anytime you want to increase if you want to get or increase optional life on yourself, you have to do that. You have to do that through VRS, through their vendor, Securian, and it's always going to be subject to medical underwriting. So you're going to have to answer medical questions, and they're going to say yes or no to your coverage. If you are, though, on our optional retirement plan or the medical center retirement plan, those are UVA plans. And for individuals who already have some optional life insurance, on either themselves or a spouse, you are able to go up one increment during open enrollment without answering any medical questions. So if you are on the optional retirement plan and you have 1 times your salary in optional life, you can go up to 2 times your annual salary during open enrollment with no questions asked, and you'll see that option right in your Workday open enrollment event. Same thing if you have optional life on a spouse. If you've got $25,000, you'll see an option to get $50,000. If you're on the optional retirement plan or the medical center retirement plan and you have never had optional coverage, or you're already at the maximum amount that you can have without answering medical questions, you won't see that option during open enrollment, but you can always apply to get optional life outside of open enrollment. It's just going to be subject to medical underwriting. So the carrier has the right to say yes or no. So real quickly, I don't want to spend a lot of time in this because I believe we're going to be talking about it a little bit with Fidelity as well. But if you are somebody that wants to enroll in a flexible spending account next year, for healthcare or for dependent daycare, you must make that election during open enrollment. So by October 13th, you'll need to go into Workday and make your FSA election for 2024. Your current election, if you have one, is not going to carry forward into 2020. Your 2023 election is not going to carry forward. If you are somebody who is already on the basic plan and you plan to stay on the basic plan for next year, you'll automatically receive your seed money from UVA at the beginning of the year. But if you are contributing on your own to your HSA, so you're adding in money out of your own paycheck, in order to have that start right away in January, you need to go into Workday during open enrollment and make that election, and then you'll have that money carry forward and you'll have that contribution start up again in January. If you forget to do that now, you can always go in sometime during the year and make that HSA election, because you can make those changes basically at will on a health savings account. But if you want your voluntary election to automatically immediately begin in January, then you need to do it during open enrollment. If you are going to be new to the basic plan next year, then you'll need to be careful about watching for emails from Fidelity, just in case they need some additional information to open up your health savings account. And if you're currently in a healthcare FSA in 2023, you're going to need to make sure that you spend down that FSA to 0 by December 31st, so that we're able to open up your health savings account on the basic plan timely in January. If you have anything in your FSA by the end of the year for healthcare, we can't open your account for you until April. So you have to make sure, if you've got that healthcare FSA right now, you want to make sure it's 0 by the end of the year. Dependent care is a little different. It's not tied to the HSA, so you can still spend funds into the grace period for next year. But for the medical FSA, you need to make sure that you get that down to 0. And I think we'll touch on this from Fidelity a little bit, but you are allowed, as I mentioned, you can contribute to your HSA voluntarily out of your own paycheck. And next year, the IRS limits the amount that you can contribute is $4,150 for an individual or $8,300 for a spouse. And then you can add an extra $1,000 to that limit if you're 55 or older. The seed money that you get from UVA counts towards that overall limit. And then we'll leave the cash match part probably to Fidelity quickly, but just wanted to remind everybody that if you are in VRS hybrid or the ORP or VRS, you are eligible for additional optional savings through supplemental savings for retirement. It's not a part of it's not a part of open enrollment. You don't have to make that change now, but we just like to remind people that everybody, whether you're in hybrid, ORP, or the older versions of VRS or the medical center retirement plan, everybody has an option to save additional funds for retirement. And Vic already covered Hughes Well, so I am going to turn the floor over to Fidelity.
Good afternoon, everyone. My name is Joel Wise. I'm a workplace financial consultant with Fidelity Investments. You guys might recognize me. I've been working with UVA for quite a while now, along with my colleague Nathan Dixon. We're both fully licensed financial planners, and we are part of the benefits package with UVA. So what we're ultimately here to do is help you to understand your retirement benefits and to take you through the planning aspect of things from your very first day from retirement savings all the way out to when you're getting ready to retire and getting ready to develop that income plan ultimately. The benefit of utilizing us is that there's no fees to meet with us. We're not commission-based representatives, so even for individuals that have an advisor outside, we can still be a great value add in those terms of situations. And in addition to that, above and beyond even just working with you inside of the UVA plans, being fully licensed financial planners, we can also help you with personal accounts, whether it's an IRA or a taxable brokerage or anything you'd like to go through there, maybe 529 plans or budgeting and debt management. All those areas are areas we can cover for you there. And again, it's part of the benefits package at UVA. So don't hesitate to set an appointment up with us. There are a number of things we can go over there and make sure that you're in great shape when it comes down to your financial future. What we wanted to go over today is some about the HSA. I know that Nathan and I tend to get a lot of questions on this and how it works, some of the essentials of what you can and can't do inside of that as well. And some of the more common things I've been hearing lately are more about how to use it in retirement. So there's 3 or 4 different areas that I think would be unique to cover in terms of that. So I want to go over that today. As mentioned earlier, several of the retirement plans can be through Fidelity or TIAA-CREF. The medical center retirement plans, the ORPs, and the 403B and cash match as well. Make sure that you look over your retirement plans occasionally, review what you have in terms of investment structure inside of those, make sure they're aligned with your goals. Additionally, make sure that you're saving enough in order to get the full max from UVA. So again, if you have the 403B plan, make sure that you're putting at least $80 in per month in order to get the $40 cash match. And if you're in the medical center retirement plan, make sure you're putting at least 4% per month, per pay period in the 403B to get a 2% cash match from UVA in the cash match plan. So very important to review those. There are a number of resources available to you to help you through that and also through retirement as well. One of the more common ones we use that I won't showcase today, but I do want to mention is the retirement income planning tool. Both Fidelity and TIAA-CREF have these, and what they do is they take a holistic view of what you're doing in terms of saving for retirement and investing, and they ensure that what you're doing is putting you on track to be able to reproduce a comfortable level of income when it comes down to retirement. Very important to look into that. The earlier, the better, because the younger you are, the more we can make changes there. They're going to make considerable impacts when it comes down to your retirement. So it is a great set of tools that we have in offerings through both Fidelity and TIAA. Don't hesitate to reach out to us. You can go to fidelity.com/schedule or TIAA.org/UVA, I believe, and you can set appointments up with us there either online or you can reach out to our phone teams that work from 8 a.m. until 9 p.m. Monday through Friday for financial planning and guidance as well. They're fully licensed advisors. They just don't work locally like we do. They're over the phone in our regional centers. So great offer they have for you in terms of retirement plans. So to jump into the HSA here. There we go. So a little bit about how it works here. So again, I'm at the benefits fair today, and this is some of the most common questions I'm getting are some of the essentials of how it works. And a lot of that was just explained, but I want to go over some of the perks of this ultimately. You can use the HSA for yourself, a spouse, or an eligible dependent. So even if your spouse is on their own healthcare plan, ultimately, you can still use the HSA to pay for those types of expenses. So a great benefit there. And then a quick note on the eligible dependents there. I've gotten a couple of questions on this recently, but it's not the same in terms of an eligible dependent as far as your healthcare goes. So for instance, you can cover a child up till age 26 years old on your healthcare plan, but an HSA, they have to be your dependent tax-wise ultimately. So you have to be supporting them financially and be able to claim them on your taxes to be able to utilize the HSA benefits for them. But if you are, then wonderful, you're able to use these benefits for any types of expenses there. The expenses we get questions on quite often, and there's all different areas and branches of that. be sure to look up IRS Publication 502. If you can write that down, look at through the list on there. It tells you what all is eligible, what's deductible, what you can and can't utilize it for. Fidelity on their website, if you log in to see your HSA, also has a nice sheet put together of the most common expenses we hear, what you can and can't do with that as well. So make sure you look into that. Again, you can cover a lot of your family members here, spouse and eligible dependents as well. And there are a number of resources you can utilize to find out if it is or is not covered as well. The primary benefit of the HSA is tax breaks. It is the most tax advantageous account you can possibly use out there. You get to contribute pre-tax dollars from your paycheck into the account. So you're effectively getting a tax break on those funds right up. And then you have the ability to invest those funds inside of the account, which we'll talk a little bit later. And the benefit to that is that there's no taxes on your investment earnings with the HSA. So if you earn it and it grows, there's no liability that you have to pay for buying and selling investments inside of that account. And then lastly, on the back side of things, if you end up using it for qualified medical expenses, it comes out tax-free on the back end as well. So triple tax benefits. You get a tax break on your taxes up front, tax-free investment returns, and then tax-free distributions in the back end as well. There's no other account that matches those types of benefits ultimately. So be sure to utilize those accounts, and we'll talk a little bit about the limits, which we saw earlier, but a couple notes on that here in just a little bit. In terms of contributions, you have the ability to set those contributions up when you enroll for your benefits. I want you to know that if you start off for the year and you didn't max the account out through your contributions through your paycheck, you also have the ability to contribute through a check or just an online transfer as well. So if you're going throughout the year and you realize that your medical expenses are going to be a little bit higher than you thought, and you'd rather pay for those medical expenses with pre-tax dollars and you're not maxing out that HSA, you can put money into the HSA and then take it right back out for medical expenses ultimately. And the benefit is you get a tax break on those funds at the end of the year. So you can still contribute to it even if it's not directly through your paycheck throughout the year to maximize the benefits and the tax qualifications there. Qualified medical expenses, we already talked a little bit about that. Again, IRS Publication 502, but there's a number of areas, and it's reasonably flexible, I think, in terms of what they allow you to utilize. So check that out. And lastly, one question we often get is that for individuals coming from other firm, they might have an HSA with an outside company. I want you to know that you have the ability to move that into the HSA that you have through UVA at Fidelity. There's often, just a little bit of paperwork that you have to do online depending upon the company you're transferring for, but you can certainly consolidate them. There's not a benefit to having two HSAs. You can't, it doesn't increase your contribution rate or anything along those lines ultimately, but you do have the ability to consolidate into the UVA HSA plan through Fidelity. So how much should you really put into these plans? A couple of schools of thought on this. And first off, for any expenses that you intend to have throughout the year that you're going to end up paying for, that you know you want to utilize, certainly use the HSA for that. Using pre-tax dollars, again, is going to put additional funds in your pocket at the end of the year. And again, even if you're, during the year, you have those expenses, you can always contribute to the HSA and ultimately take it back out of there to get your tax break. So if you're planning for certain medical expenses throughout the year, absolutely at least put that amount of money into the HSA there to get yourself the best tax break as possible. And on the other side of things there, you probably want to have at least as much as your deductible in there as well, just in case you end up having some type of medical expenses that's greater than what you originally expected. You'll have the funds available in your HSA to cover your deductible there. And then after that point, it's only minimal expense you should have moving forward with your healthcare account. So contribute at least what you can in order to cover the essential expenses and then up to your deductible as well. Now, we went over this, so I'm not going to spend a whole lot of time on it. There's some additional amounts available this year. They've increased just by a couple $100 ultimately. So again, for an individual, $3,850. If you are turning 55 or over 55 this year, it's an additional $1,000 above and beyond these. The one thing I do want to mention here is that, as mentioned earlier, if you're an individual, UVA does contribute $1,000 into your account. If you are in a family plan, it's $1,500. And what UVA puts in does impact your ability to contribute. So for instance, if you are a family and you're getting $1,500 already from UVA, that means you can contribute $6,250 a year of your own money into that plan. So make sure that you're setting up so that you're not maximizing or over-contributing the end of the HSA account there because, again, their contributions do impact what you have the ability to put in. So why is this also important ultimately? Well, and the answer is that healthcare is expensive, right? We're all with inflation and whatnot these days. We're all vying to find out better ways to save money. This is one of the best ways to do it. And most people these days are looking for the most tax efficient strategies for the long run for the retirement income as well. A lot of people that I talk to these days are, instead of utilizing their HSA on a annual basis there while they're working, they're paying for a lot of healthcare expenses out of pocket if they can. And then what they're doing is they're allowing that HSA to continue to grow and compound because you can continue to roll it over, and they're using it for a retirement account as a healthcare account more specifically. And if you look at expenses in terms of retirement and healthcare, Fidelity estimates that on average, a couple who's going to retire at regular retirement age, 65, 67, and live until normal ages there with just normal healthcare expenses, it's going to spend right around $315,000 over the course of their life. Now, those expenses aren't linear. They're a little bit they're on the lower end up front, as you can imagine, and then they go up a little bit higher, obviously, as you get older and older and need more. And this is without any long-term care expenses included in that as well. If long-term care gets involved in this, probably preaching to the choir. You guys all know about it out there ultimately, but it can jump these numbers up substantially after that. So if you look at these expenses, it can put a significant weight on a retirement portfolio, and that's the best way, or one of the best ways to be able to mitigate that, is to be able to have a sum of cash available with considerable tax benefits, which is what your HSA could ultimately be in retirement. So contributing and investing in your HSA, what could these dollar amounts ultimately look like over the course of the long run? Well, if you put $1,000 in your HSA over the course of 20 years, and if you get an average rate of about 7% in returns, and the way we figured that in is that most people leave a little bit of money in cash inside of their HSA for any eligible expenses. So we figured the first $2,500 you put in there, you just earn 2% or so in a money market there to make sure it's readily accessible to you, and that you invested all the money after that as well, and just allowed it to compound and grow. If you just put $1,000 in that on an annual basis over the course of 20 years and got that 7% rate of return on everything over the 2,500, you have right about $40,000 at retirement. If you double it up to $2,000, you'd have north of $80,000, and if you put $3,000 in a month, it's almost $130,000 that time frame. So very small differences in what you ultimately contribute with your account can make a considerable difference in what you have at retirement there, and wouldn't be too long before you had enough to be able to cover most expenses when it comes down to retirement. So what that last infographic I showed represented is investing those funds. And that's one thing I get a lot of questions on there is, should I invest it and what should that look like? You should ultimately, again, have whatever you think you're going to use this year in cash readily available. But anything above and beyond that for your HSA that you're planning on using for the long run, make sure to invest those funds. Excuse me. Again, you get tax-free investment returns on those accounts, and there's a number of different investments available through your HSA to be able to do that. The benefit to keeping some in cash is that it's immediately accessible to you, but even if you didn't have it in cash, you can always sell out of any funds that you have inside of your account, and within a few days, those are available for you again to be able to take withdrawals on as you might ultimately need them. I get a lot of questions about medical expenses in retirement as well, and I wanted to pull up another screen here. So this is a great article. I'll show it to you all. This is what I wanted to talk through, and this is a good pitch for Fidelity here. Fidelity's viewpoints, if you haven't had the opportunity to enroll in those right now, if you go to Fidelity's website in the bottom right, there's viewpoints, and they might have moved it. They changed our website recently there, but if you sign up for them, they will send you one or two viewpoints per month, and they're really well thought out on a number of different financial topics. And this is one that hit with me recently because these are the most common questions that I get on a regular basis. And what they do is they take a lot of feedback from the financial planners like myself and Nathan who are doing this to try and find out what people often have concerns about with regards to in terms of healthcare and other aspects of retirement. And these are some great areas there to think about. So first off, in terms of healthcare, as far as retirement goes and your HSA, a few different things people tend to do as far as setting their account up for success there and what you can and can't do with it as well is, number one, help bridge the gap to Medicare. And for individuals that are retiring before age 65, as you're probably well aware, healthcare costs can be pretty expensive at that time frame. And generally speaking, HSAs are not eligible to use for pay for private health insurance premiums. However, there are two exceptions to that. First off, if you have COBRA through your employer, you do have the ability to utilize your HSA to pay for your COBRA expenses, Or second, if you are on a unemployment compensation, you can use your HSA to pay for medical premiums during that time frame as well. So you don't necessarily have to be close to retirement, even if you're in your 30s or 40s and find yourself unemployed at some future time frame there, and you need to cover yourself or your family in terms of medical expenses. During that time frame, you have the ability to utilize the HSA to bridge that gap between either when you separate and when you retire, or when you separate and get a new job ultimately. So a great benefit there in terms of how to bridge that gap for individuals and tending to get out prior to 65, and again, we'll be on that COBRA type insurance. Medicare premiums is a really common one that I get. And I want to mention something about Medicare too, for those of you that are planning on working past 65. Some people end up filing for Medicare Part A at 65, and that's fine if you'd like to. It ends up working as a supplement ultimately to your health insurance. But be aware, when you file for Medicare, you are no longer eligible to make contributions to an HSA. So if you have the high deductible health plan, you're continuing to make these annual contributions into there, hold off on applying for any type of Medicare until you ultimately leave your employer. You don't want to miss out on any benefits over the course of the end years there, and these are considerable benefits when it comes down to retirement and tax breaks for you, which are generally people's most expensive years, those final ones. So keep that into consideration. Now, in terms of Medicare premiums, Part B and Part D coverage are eligible to be utilized from the HSA. So you do have the ability to take the HSA for those types of funds there. However, any other supplementals like Medigap policies are not eligible. So be aware of that. You can pay for part of your Medicare ultimately, but not for the course of the long run there with anything other than Part B and Part D. Long-term care expenses, I get a lot of questions on this too, and honestly, I don't think a whole lot of people these days are purchasing long-term care policies. A lot of them that are out there aren't covering quite as much as they used to, and the honest answer is they're a little bit too expensive for most individuals out there. However, if you are the individual that is into purchasing a long-term care policy, I just want you to know that some of the premiums that you ultimately have for those can be covered, and it varies depending upon what your age is. So the closer you get to retirement there, the larger the amount that you have the ability to pull out. I think for someone, age 70 or greater, it's in the $6,000 or $7,000 range is the amount you have the ability to pull out on an annual basis and use those to pay for your premiums in terms of long-term care. For people that are in their 40s, it's only several $100s per year. So they try to mitigate that or change it ultimately with what they think your policy premiums might be based upon age there. It's not going to cover everything, but it'll cover at least a portion of what you have at that time frame. And then lastly here, paying for other expenses. This is a very important one here. People often say, well, what if I get to 65 and, I'm not going to need them, or maybe I need it for retirement expenses? I want you to know you have the ability to access these funds at 65 for non-medical expenses ultimately. The difference is that when you take a distribution from a non-medical expense, you are going to pay your regular federal and state taxes. If you do it prior to 65, you're going to pay penalties on top of it. But if you do it 65 or later, there's no penalties, just income taxes. So it's still most ideal ultimately to utilize them for healthcare expenses. But if you want to, as it uses an example here, purchase a boat, you could certainly use the HSA for that. It's just going to work like a normal retirement account. You're going to pay your regular taxes. And then lastly here, just to mention, if you don't end up using this for whatever the case might be, you pass early or you're in great health for that matter, and you just don't ultimately need it throughout the course of your life, you can certainly pass these funds on as well. If your spouse is the beneficiary of the account, the spouse assumes that account as if it were theirs. So there's no taxes or anything involved with that. They assume it. They have the ability to use those funds at that time frame. If you're electing someone other than a spouse, however, as the beneficiary, say a child or a nephew, whoever it might be at that point, in the year that you pass away, those funds are ultimately considered taxable income to that individual, and then they have the ability to access and use those funds as they leave. So that year. So at that time frame, again, when you pass away, if it's not your spouse, it ceases to become an HSA and just pays out as a taxable account to your child or whoever is the beneficiary at that time frame. And last thing I want to mention, this is more on the estate planning aspect too. However, depending upon your tax situation, if you are not leaving it to a spouse but to a child, you might want to look into your estate as well. It's possible that depending upon your child and depending upon your estate ultimately, your estate might have a lower tax rate than your child would have. So if that ends up being the case, you could always leave the funds to your estate, pay a lower tax rate at that time frame, and then the assets would get passed on however you had your estate established, likely your child at that time frame. So a lot of different strategies there ultimately in terms of structuring this in terms of retirement, and a lot of flexibility as far as how to use those at that time frame as well. So if you haven't yet, again, open enrollment is now, as they've been mentioning here today. Make sure you enrolled in that plan. If you're in the high deductible health plan, open your Fidelity HSA online. You will get a notification from Fidelity that is eligible. You can log in online with us. You can see your account balance. You can invest it. You can get investment guidance ultimately inside of there. You can take distributions. You can make contributions. The website that we have is very flexible, and it's right at the bottom there, netbenefits.com. So you can log in there to see your accounts, create a username and a password. And then if you have any questions or concerns, a lot of good information. We just scratched the surface here today, but if you go to fidelity.com/health savings account, it is an excellent resource to be able to look over what you can or can't do with these plans. Again, looking at that IRS publication 502, you can see your plans, structure them the way that you want to. And if you need any help, you can either call that number right there to talk to a HSA specialist, or if you text HSA to 343-898, Fidelity will text you a couple of different resources and links you can utilize in order to learn a little bit more about these as well. That's all we had for today. I believe I'm passing it back to someone else in order to answer questions or to mitigate those. Okay, excellent. Well, no questions. Thank you all for attending. We do appreciate it, and have a great afternoon.